Hello, and welcome to Chapter 6 of your tax course with your host, Professor Naragon. Now, we're bringing you some extra credits and special taxes that are involved with the tax return. This includes learning a little bit of the methods going on that happen with Schedule C, possibly, or if ever you get into a business tax return, you gotta know a little bit, also basic accounting skills. We're also going to get into quite a bit of other items, including alternative minimum tax. You can see here, self-employment tax, the special nanny tax that is dealt with household employees. We even have the kiddie tax that's coming in. Now, so we're going to get into all these little special items and get you the basic knowledge of what these are and basic calculations. This chapter is probably going to be the shortest of them all because it's very straight to the point. So let's go ahead and get into it. Starting off of what is accounting periods? Okay. Mostly accounting periods are the calendar year. For any individual that files taxes, it's usually a calendar year, January to December. But every now and then we may have, with partnerships, S-corps, any personal service corporations owned by individuals. So again, a little bit of Schedule C. This is the self-employment stuff. They may actually change the actual calendar year, which is known as a fiscal year. Okay, and this could be making the year end on a different scope. Okay, they can make if the IRS approves, they can make the year end on September, October, November, August, April, any month that they want to, but still has to be 12 months. So this brings in a little bit of trouble coming in every now and then with the tax returns. And again, you're going to see some things that are not with this text. This is going to be with like your business tax course that you would have. But again, like this, partnerships do pay tax as an entity, as corporations don't either. But the only ones that pay tax as an entity is, of course, the C corps. Those, again, you get into your business tax. But this is usually we're going to have, once they've said, okay, you can have this new ending period. Well, it brings in something kind of interesting called the short period tax income. And this really happens in the short year. And again, here in the state of Texas, we can actually put an LLC as on our Schedule C, so a limited liability corporation, and we have to follow a certain amount of rules. So, how do we do this? Well, it's actually not actually pretty tough to calculate the short-term tax. So we're going to take this example here. We got Organic Dairy LLC. And they changed from a calendar year to a tax year ending of 9/30, basically September. For this short period of January through September, Organic Dairies LLC income is $20,000. Okay. Now, with short years, we have to make adjustments to this. So they actually get a special adjustment. And again, this really only happens the first or last year of operation. So, how we calculate taxable income for them? It's basically going to be 20,000 times 12 divided by however many months in the short-term period. Since we're dealing with September, we have 9. and this gives us the 26,667. Estimated tax on analyzed TI. For us, the tax is 15%. Always watch out on your tax rates. Again, those do fluctuate, so it could actually be something a little bit different, maybe not, but we take whatever amount from our annualized taxable income, times it by our tax rate, and we find out that our tax is $4,000. Okay, now here comes another one. We have to allocate this tax to the short period. Basically, how much tax is actually in this 9 months. And this is basically taking our estimated times now 9 over 12. As you can see, they flip the fraction. And we get 3 grand. Now, again, we really just do this just to recognize that there is a short year. The remaining tax, the 1,000, will actually be incorporated into the next year flow. So really we're trying to figure out the entire 12-month tax, and then we just allocate it between the years. And again, you get this mostly with your business side. I just want to make sure you kind of understand a little bit of this like special kind of tax that ends up happening. And this again, something that we briefly got into with the Schedule C. We're going to get, again, here's the accounting methods, just throwing in. Now, there is 3 that are acceptable accounting methods: cash, the hybrid, and the accrual. Hybrid, that one you don't see as much. It's either going to be cash or accrual. And again, cash is actually receiving cash, and we're just recording when we receive the cash. Accrual is when we have accounts receivable, accounts payable, where we actually have to recognize the revenue and expenses when we've earned them. Okay? So we're recognizing revenue and expenses when we earn them. Cash we recognize when we receive the cash. You must use the methods for tax and books. You cannot change it up. Okay? If you change it up, IRS and your investors do not like that. So they are very key that it must stay the same. Does it always? No, but stay the same. Okay? Hybrid, again, we don't see much of this. This tends to be somewhat in manufacturing more, with them recognizing cash when they receive it, but then cost of goods sold gets accrued. I would definitely just stay away from this one. Hybrid, again, is barely seen. And notice this, again, must use one method consistently. Again, you cannot switch from cash to accrual. You have to basically stay with one method and then obtain permission from the IRS to change. Okay? So, watch out on doing that kind of stuff. Remember, basically, IRS says you can't change it unless we let you to. So, you must ask them politely to change from cash to accrual. But then again, cash does have its, it's going to have some, basically, things that, you can claim cash and some people cannot. Okay? Again, cash tends to be mostly with individuals because we deal with cash. We recognize income when cash, again, is actually done. And again, recognize deductions. Here's the can't use. So you have to know who cannot and who can use. Okay? People that can't use cash basis. C corporations. Ain't gonna happen. If you're a corporation, you must be accrual. Okay? That doesn't even care if you don't have receivables or payables. you have to recognize revenue and expenses when they happen. Partnerships with a corporation as a partner. Again, you got a corporation dealing involved, can't deal it. If you have gross receipts more than 25 million, okay? Anybody that has less than 25 million, you can use the cash method. That one's a little bit confusing right there, but it has to be more than 25 million in gross receipts. So, and if it's a trust with unrelated business income, okay, that, or we still have to do a different method than cash. Also, I mean, people that get to use cash a lot is people that actually are farmers. Farmers get to use cash no matter what, so they don't fall under any of this. This is where it says certain organizations, even the farming community is a C Corp. Farmers get a little bit lucky, okay? So, the other methods, again, accrued method, recognize income when earned, and can be reasonably estimated. And then, of course, recognize deductions when they have incurred. And then, here's the hybrid again. This is the example that they use, or the one that I've just previously told you. Again, hybrids don't get used very much, so basically know what an accrued method is, or cash method. If anything with the hybrid method, just understand that that can be a multiple choice question, but it is not typically used. It's either cash or accrual. I have, in my career, never seen the hybrid. So, it's very, very little that we have. Now, the next part in this chapter is dealing with related parties. And related parties, we really have a bunch of restrictions to this, and we're just going again some common stuff here. Again, we're not going to dive too deep into related parties, but to know the basics to it. And there are actually restrictions on transactions between related parties, including recognizing loss and sales between parties. I mean, some we can't recognize and some we can. You really had this more with your Schedule D when we did a little bit of the related parties back in that chapter with stock sales and how to recognize, okay, how much is the basis here and there. And so we have to watch out. You will have one accrued basis and one cash basis taxpayer as pertains to expenses, unpaid expense, and interest. We're going to restrict that also. Again, that's two different methods going at it. So we actually have to set it up correctly. Basically, make it to where it relates to itself. Now, again, there's a lot of rules that actually define. The book just, again, wants to go more simple, common relationships. And these are usually what we see, okay? First, we have the family members, such as spouses, lineal descendants, so father, mother, children, grandchildren, grandparents, siblings, brother, sister, so forth and so on. IRS really does look at this. They're going to watch out on these losses between family members. So, if you decide to give your family member a loan or anything like that and try to write off the loss, you better watch out. Okay? We don't want to get into, just watch out when you're handling family. Okay? Again, the book, if we want to look right into the book, because you know I like going into the book. And again, they go through examples of the losses, and again, it's dealing with stock, so it's again back to Schedule D most of the time. And this is unpaid interest expense. So here's the relationships again. Notice that they're not going too much in depth into it. Again, they're looking at more just the common stuff and how the related parties work. Again, it's watching out with certain things. So other types that we get is a corporation with more than 50% of an owner. Okay, that's more related. We gotta watch out with that because again, they want to make sure that you're not taking the losses and the gains, and they're going to restrict a little bit of those. And then you have these two other terms known as the brother-sister corporations. These are the corporations that basically are treated like siblings to each other. They're on the same level in the corporate structure of the conglomerate or whatever, and basically they can do a horizontal kind of item. Then you got the parent subsidiary corporations. So that's the ones with a main corporation, and then you have these corporations underneath it that they basically trade back and forth. Again, IRS really does look at these, and they're making sure that there is no fraud going on. You're not hiding stuff. You're not trying to basically cheat taxes. Okay? So, here's basically some things that go on, especially with losses. Losses are disallowed between related parties. When property is sold later to an unrelated party, all previous disallowed loss may be taken against the gain. So again, it can be sold many times with the family. You cannot take the loss until it's sold to an unrelated party, and then it can go through to almost everybody. And that's what the book is trying to get down to. Now, they bring in this considered constructive ownership and determine whether parties are related to each other. Under this, they have these three rules. So, this is again a little bit more going into. A taxpayer is deemed to own all stock owned by his or her spouse, brothers, sisters, ancestors in lineal descent, again, family members. A taxpayer is deemed to own his or her proportionate share of stock owned by any partnership, corporation, trust, and he or she. So this is that 50% one. And the taxpayer is deemed to own any stock owned directly or indirectly by a partner. Okay, that's kind of like another little brother or sister thing. Okay, so it tries to get into a little bit of here. And so it's always good just to read the book. It's nice and fun. I know it doesn't seem fun to read the book, but I love how this book is and how it actually gives the good examples and stuff going on. So again, this is again all about when we deal with capital gains and losses. We basically hit related parties. So they're just coming back in just as a refresh. So let's get into other items here. The first one that we're going to get into is a special tax kind of known as the kiddie tax. So you're going to hear this every now and then, and this is basically any unearned income of dependent children / students. I like how they do that. This one right here is basically for stocks, bonds, anything that we haven't physically materially worked for to earn. So interest, dividends, and again, sales of stocks, capital gains, and capital losses. So, and again, partnerships do go kind of in here, trust, so forth and so on. So, provisions designed to prevent parents from transferring income-producing assets to children in lower tax brackets. That's basically what the kiddie tax is. Parents have did this a lot. They go, oh yeah, my children are at a lower tax rate, so we can file a tax return for them, and will get the lower tax break. IRS saw through that, government saw through it, and they say, So now you got this net unearned income, or NUI, however you want to say it, of dependent children is taxed at parents' highest tax rate. Okay, so can't get through it, you're still going to get taxed on it. IRS is still going to get their money because a few bad people actually use this to try and get the lower tax rate. So this applies to all children with at least one living parent that can basically claim them, who is 18 or younger at the end of the tax year, or again students that are in between the ages of 19 to 23. Oh my god, it's dependents again. Okay, so it's dependent rules. And has net unearned income. Okay, so this is our calculation of net unearned income, and it looks like the PowerPoint has lost a number. So let's go find this in numbers. So come right here, and we're dealing with the unearned. So let's find this little number that has gone missing. And it looks like we're looking at probably, it does not really give it very good of what that missing number is anymore. Again, because the tax code changes every now and then, we have missing numbers. And this one, again, 1933, we have a net unearned income of more than $2,100 for 2018. This one looks like area standard deduction greater than probably a 1. Because right here in the books, here's the 1,050. Okay, so I don't know why that went missing. Sometimes that happens. So if you're just reading the PowerPoints, you may want to check out this video. Fixes it up. Okay, so calculating the taxable income in itself is our step 1. Again, gross income less child standard deduction greater of 1,050 or earned income plus 350, but not to exceed standard. Okay, so step 2. So again, standard deduction. Basically, we're going to be looking at something that doesn't exceed threshold of 2,100. So kiddie tax is assessed using rates that apply to trusts and estates on a portion of taxable income that consists of net unearned income and that exceeds the unearned income threshold of 2,100. So here we go. Over 0 but not over 2,550. Tax is nothing. So this is basically how the child tax is computed right here. 2,550 to 9,150. Tax is about $255 plus 24%. So of excess over 2,050. Here 9,150, 12,500. Tax is 1,839 plus 35%. 12,000. So as you can see, there's these percentages that are added on. And again, we got these examples going on. Here we go. Alice is a single child under 18 with 3,200 of interest income and no earned income. Okay, her standard deduction is 1,050, the greater of 1,050 or earned income of 0 plus 350. So here, her taxable income is 2,150. 3,200 minus the 1,050. Here we have Boris is a single child under 18 with interest income of 3,200 and 5,000 of earned income. Standard deduction, again if we're using the kiddie tax, 5,350 because it's 5,000 of their earned income plus 350. So taxable income is basically 3,200 plus the 5,000 minus their standard deduction. Okay, so here we have single child under 18 with 11,500 of interest income and 12,400 of earned income. Standard deduction is 12,000. Okay, 12,400 plus 350 exceeds the standard deduction for a single taxpayer. Okay, so when it exceeds our single taxpayer, we can only take the 12,000 standard. And we should actually recognize that very quickly because that's over. So taxable income, 11,500 plus 12,400 equals basically 11,900. This person right here be following their own tax return. I'll be honest on that one. Even under 18 and a child, they probably should be following their own. Okay? Alright. I just didn't like that with the PowerPoint, how it didn't really explain too much of what the standard deduction is or how to do it. So again, book gives examples. Step 2, we calculate net unearned income. I'm going to stick with the book. I like the book better. So here we're going to compute the net earned income. And again, net unearned income is generally defined as unearned income less than 2,100. A child with large itemized deductions associated with unearned income may be different. Okay? Again, this is the big thing. It's not derived from any wages, salaries, or similar compensations of income from a trade or business. Mostly it's unearned through investment income as interest, dividends, and capital gains. So here's our examples again. Alice is a single child under 18 with the 3,200 of interest income and no earned income. Her net unearned income, NUI, is 1,100. Again, that's the 3,200 minus the 2,100. So, always take 2,100 away. Usually helps. Okay? Again, it's anything that exceeds the 2,100. So, unearned income, less. So, can we have a negative? Yeah, if we have a negative, then there's really nothing we can do. So, again, Boris, same example. 3,200 minus 2,100 gives us the same amount. Here we have 9,400. Now, computing the earned taxable income. Okay, so earned taxable income in itself is the residual amount of tax income after reduction of the NUI. So taxable income less than NUI. So again, Alice is a single child under 18 with 3,200 of interest income. Her ETI will basically be 2,150 minus 1,100. Okay? Which equals out to the 1,050. So, how do we get those numbers? Well, here's our first one, taxable income, where we came up here, where we had to take out the standard deduction. Then we subtract out step 2 right here, the 1,100. So basically those two subtracted to each other gives us our earned taxable income, which happens to be 1050, which is cool. Boris, it's a little bit different. His was 2,850 in step 1 minus step 2 of 1,100 gives us the 1,750. And the same thing with example C. So those are a little bit easier. Now it's time to calculate the tax. Alright, so the tax on annuity is calculated at trust and estate rates, and the tax on ETI is calculated at rates applicable to the child's filing status. Meaning, basically, there's 2 rates. I know, it's like, oh my god, 2 rates, I have to know. Well, one is right here. Here's the table. So this is the tax rate. So, start off with our example here. Example A with Alice. Oh, that's step 3. Here's step 4. So again, Alice is a single child, and we have that 30,200 with no earned income. Love that. Here's her tax, and this is basically found out as simple as the NUI. So the 1,100 that we figured out in step 2, right here. There she is. Whoop. Times 10%. That's the table tax. So again, up here in the books, here's the table tax. So she gets 10%. So again, that's going to be the 1,100 times 10% of the tax at trust. Now, the 1050 that we computed in step 3, the ETI, also gets times 10%, and she's taxed as single taxpayer. So she gets the 10% going right there. So we add those two together, and that's where we get Alice's tax. Now, Boris has the same basically tax right here, 1,100. Again, he's at 3,200, but using this table in itself, we're basically looking at what our NUI is. And since it falls between this bracket right here, that's why we use 10%. Alright. So with that, we now have his ETI, which we calculated in step 3. And we take that by 10%, and we get 285. Again, all these are taxed by single taxpayers, which happens to be 10%. Okay. The last one that we get is Carol, and she's a single taxpayer under 18. Again, with that 11,500 and interest income of 12,400. Carol's tax is a lot higher. Again, first off, we have 1,927 of trust tax on 9,400. So the way that they compute this, as you can see, we have 1,839. This from the table is right here because she falls under this bracket. So we have 1,839 and plus 35% of the excess over 9,150. So this is where you get the 1,839, and this is why they're subtracting 9,400 minus 9,150. Again, the reason why is, of course, again with the table itself, anything above 9,150 is going to be times at 35%. So we have to read that table and understand what's going on again. So again, the repeat to this, her NUI is $9,400. So that falls in this bracket. According to this chart, this table, tax has to be $1,839 plus 35% of anything of excess over $9,150. So 9,400 minus 9,150, that excess, which is about 350 in itself, has to be times by 35%. Okay? And then added to 1,839. So back to her. So again, that's why we got that, and that's where the 1,927 comes involved. And of course, we take her step 3, her ETI of 2,500, times that by 10%, add those together, and we get that 2,177. So when we actually look at the kiddie tax in itself, you're going to see this in the tax return, and this is form 8615. And again, don't worry about this draft. This is the actual tax one. The book does these drafts because of the publishing date. Okay, but it is actually this form right here, 8615. So again, it goes through all the calculations. It's going to have all the kid stuff going here with the first figuring out the NUI, then it's going to figure out the tax. Not much to this one. It's a very simplistic one. Again, we just have to figure out, we have to know the math involved. Cool thing again, a lot of softwares, we don't have to actually do all the computation. We just have to know to make sure the software is doing it correctly. Again, software makes mistakes. That's why they have updates. So usually watch out on anything of that. Okay? And that's going through these 4 steps without using the PowerPoint. Alright, so elections to include child's NUI on parents' tax returns. Okay? Now, parents can elect to report the income of child under 18 on their tax return. Usually parents will do this just because, they don't want to get in trouble with the IRS, because the IRS will come down and say, hey, this wasn't taxed. We're going to put it on your tax return anyway. So, mostly parents tend to elect to do this. They don't have to. They can file a child's tax return. That can go either way. But, again, this is only on unearned income. So, if the child does make money, like they got hired on with Pizza Hut or some little small business, and they make a wage, they have to file their own tax return to claim a refund. But parents do end up claiming the kiddie tax in itself. And again, they like to do this much simpler than filing return for the child, which requires form 8615. As you just saw in the book, this is all that really needs to be required. You don't have to go do another return just for the child. You can just do it here because, again, it still ends up being the same tax rate. I know, they just mess with you. So, can elect if the child is under 18 and has only interest dividend income between $1,050 and $10,500. This is why I said that example C feels more that it's going to be more that they have to file on their own, but because their NUI is going to be roughly in between $1,050 and $10,500, they are still considered able to be elected. Okay. And then also we can elect if they paid no estimates or backup withholding during the year. Okay. So most likely it's easier just to elect. Easy said than done. So that's the kiddie tax. The other tax that we get is known as alternative minimum tax. Okay. This tax, again, this was created basically for high income people, and this was just to make sure high income people pay tax and didn't try to write off or itemize everything. And it actually evolved in a way that actually impacted a lot of middle income people, and this tax has become very, very mean in the way that it works. And a lot of people don't like it. In fact, I know this has been up for legal debate of trying to get rid of the alternative minimum tax. The only reason why it doesn't is because it still makes high income people pay. So, if AMT is higher than regular federal tax liability, you still have to pay the annual minimum tax, and they really do separate parallel system. This is just making sure, again, people basically pay. If they're high income, they're going to pay tax. They can't get out of it. So the alternative minimum tax rates that we end up getting, and this has been the latest. Again, take all the rates as things that can possibly change. So always stay up to date with all these rates. Right now, 26% up to and equaling 191,100 or 95,550 with marrying filing separate. I don't know why marrying filing separate gets separate. I mean, special little thing. Again, that's in the tax law. It's a cool little thing. Every now and then some benefits happen of the alternative minimum tax base. Okay, so again, if we get up to 191,100, it's 26%. 28% above the amounts above the 191,100, or again, married filing separate. Long-term capital gains and qualified dividends tax at preferred professional rates. So that's the rates in itself. Again, the book helps a little bit. I think they really do provide more examples of what's going on. So, or actually not. It really doesn't matter. But as you can see, designed in the 1960s. So it's not an old tax law here. This was just basically trying to get these wealthy taxpayers to pay. So, how we calculate this is right here. Alright, so calculation of alternative minimum tax, how the book puts it, is basically adjusted gross income, and we either add or minus alternative minimum tax adjustments and tax preferences, and this equals the tax income minus the exemptions equals amount subject to alternative minimum tax times our rate, and this is minimum tax minus any regular tax, and do if only if it's positive amount. If regular tax beats out alternative minimum tax, then hey, you don't have to pay AMT. Okay. So what are some of these exemptions and stuff like this? I mean, this is the simplistic version. So here, common adjustments are preferences that we get. A lot of times is timing differences. They either happen at the beginning of the year or at the ending of the year, period, so forth. And then there's special provisions for regular tax that are not allowed for AMT. those again change with the tax law. So there is some preferences that we go with, some with stocks, a little special. A lot of times we don't have a lot, but again, this actually shows a lot of stuff that we deal with this form in itself. So when the book looks at it, common adjustments are included state income tax refunds, net operating loss, calculate different for AMT. Again, this is stuff that dives deeper, that you'll find more with other items, other courses once you dive deeper into taxes. And again, since it changes so much, it's hard to pinpoint. So we're giving you mostly the common, the overview. So some passive gains and losses, differences in regular depreciation. So exemptions, itemized deductions, most of those we have to adjust. Excessive depletion over cost, intangible drilling cost, that's for oil and gas. And it says see the list of preferences and adjustments. You know what? It's easier just to look here. Okay? So, here's the tax refund from Schedule 1. We have to put that in. Notice again, it's in parentheses. So, we're going to subtract that out. We have investment interest expense, depletion, difference between regular tax and AMT. And this is other stuff we would have to actually figure out. Okay? Again, we can go into alternative minimum tax as one whole course. That's how much different it can be. We're just hitting it real quick in a short supply. So this form in itself gives you all the adjustments right here. Helps out very quick. Okay. And then of course a little bit other adjustments. So I don't think it really gets too much. Again, let me zoom out. So right here is a lot of the common stuff again. And what's not allowed, what's allowed. And then here's, again, like I said, it changes so much. Certain deductions in 2018, the following AMT adjustments no longer apply. Again, this is stuff we've already gone through, so no worries on that. Again, it changes as we go. Okay, so the other thing that we get with the AMT is in itself the exemption amounts. Again, these have increased substantially. So married filing jointly, we have 109,400. Married filing separate, 54,700. Even single and head of household has now jumped up to 70,300. Exemption is reduced by a quarter for each dollar of alternative minimum tax income over phased out amounts. So when we reach up to over here, it does start kind of going down a little bit. As you can see, here's our exemptions, here's our single, and then here's our married filing separate, and then there's our thresholds, 100, 500, and 500. So the current examples in ourselves, Abby, a single taxpayer, has AMTI of $126,000 in 2018. Her AMT exemption is $70,300. Reason why? Because she hasn't beat $500,000. Okay. Once she reaches over here, it starts fading down. Here, Diamond and Tiffany are married filing jointly. Their AMTI is $1,234,000. Well, that's definitely over $1 million. So their exemption is going to be $109,400 right here, and watch this thing reduce. So we're going to subtract the difference between 1,234,000 and 1 million in itself, the threshold amount, which is basically 234, and times it by 25%, and basically a quarter, 25 cents. Once you do this, it drops down their exemption to actually 50,900, which means they're probably going to owe a little bit of tax. Okay, so again, right now, tentative, all this phase out stuff, and it will be over in 2025. We don't know if that's for sure, but again, with the law, always check with this. Again, this is one that actually does change, so keep an eye out, making sure that you always understand the thresholds in itself. So, and then again, back to this form in itself. Notice that the form in itself right here gives you the exemptions. So it's always good to have these forms to you, because it goes step by step of what can be used, what cannot, and it helps out. So that's a brief overview of alternative minimum tax. Will it come back? Probably will. So just keep an eye out. Again, here's our self-employment tax again. It's come back from Schedule C. So self-employment tax in itself, again, you see this one, the Federal Insurance Contribution Act, or FICA. Again, know a little bit of payroll. Poses the two tax. One is Social Security, or Old Age Survivors and Disabilities Insurance, OSADI, which is Social Security, okay? And that's at 6.2%. So up to 128,400. Once you hit that amount, you're good. That's as far as it goes. Medicare, so that is actually your gross. So for self-employment people, this is our income. If our income reaches 128,400, that is the max that they're going to tax on. So after you hit over 128,400, you don't get taxed on Social Security anymore. Medicare is 1.45%. So again, same thing. That one actually gets taxed no matter how much you get. And then you got an additional 9% in case you got income over 200K. So, yay. Or if you're married and filing jointly, 250,000. So self-employment tax ends up hitting us hard, okay? Because of this. I mean, this is just the regular. This is what comes out of your wages, okay? But self-employment tax, well, guess what? They pay both shares of FICA, okay? Employers pay half. You pay half if you have a W-2. If you're self-employed, you pay it all. I know. Oh my God. And this is what hurts a lot of people because they don't understand this part. So if you're going to become a tax accountant, advisory, advise them about this if they're going into their own business, that they're going to have to pay the full amount. So, again, it's double the amounts, like double mint gum. So you're dealing with 12.4% in Social Security, and Medicare gets 2.9%. Again, 9% additional if it's over those taxable income limits. They're paid on, again, the partnership income and net income as an independent contractor, and reported on Schedule SE. Okay, multiplying self-income by 92.35%, and then multiply by 12.4% and 2.9%. And then, of course, we get into the whole little qualified business income. Again, that helps out. Let's see if the book actually shows the schedule. Boom, boom, boom. Here's the tax rate, self-employment tax. And this shows throughout the years that it does increase. So again, this is another thing to watch out on, to always look over, because as you see, it has increased of how much Social Security actually gets taxed. So again, self-employment. And this is showing the example. So employment before self-employment tax deduction, net income, we had 136 times that 92.35, tentative net earnings 125, so we get 128,400 less FICA wages, Medicare doesn't mind, and boom, here's our rates. Okay, so again, this is just basically figuring out our actual wages in ourselves. And then here is the self-employment tax. So cool, does have it. If it didn't, I would have popped up on the IRS.gov. It's good to know these. Again, there's a short form, which makes life a little bit easier, but well, people do tend to go for the long form. Don't know why, but long form tends to work out a little bit more. So self-employment tax, all right here. And again, it's always good to kind of go through these, see, understand how they work. Again, we kind of got into this with when we did the Schedule C chapter. So, last little bit of taxes are special tax that has to come in play is what is known as a nanny tax. Now, again, there's other taxes for high income, which we'll get into just a sec, but these are the special nickname ones. And the nanny tax, in fact, in itself, is basically what is known as a Schedule H for household employees. And this is basically if you pay more than $2,100 of cash payments to a household employee. We actually have to start paying them wages or paying the FICA tax. Okay? And sometimes you actually have to withhold federal income tax and pay unemployment. So if you're considered hiring basically any kind of household worker, this is something you have to put in. Basically, you're giving them a wage. That's what's going on. They're part of your employment. So they have examples right here: cooks, maids, caretakers, etc. The most common one is the nanny. So that's why it's called the nanny tax. And again, we have the Schedule H. That will happen on 1040. And you can include on Forms 940 and 941 if you have other non-household employees. If you want to use that, that's for businesses. But mostly we have Schedule H. So, again, I like this so you can actually see. I don't want to get feedback right now. Alright, so Schedule H. So here's our Schedule H. These are actually pretty good, pretty interesting. Again, this is basically determining our wages, and we can actually write off some taxes if we've already paid these. So again, follow a little bit of the rules. So, did you pay any one household employee cash wages? Yes. If your household employee was your spouse or child under age of 21, your parent, or anyone under 18, see, those, that's just giving an allowance. Don't worry about that too much. Did you withhold federal income tax? Hopefully you did. If no, you're going to end up paying. Did you pay total cash wages of $1,000 or more in any calendar quarter of 17 and 18 to all household? If no, stop, don't file. Again, that's if you paid cash wages. If yes, skip lines 1 through 9, you go to line 10 because you made it to C. If you said no and no, okay. But if you said yes, you skip lines B and A, go straight to here, and you put in your wages, Social Security tax, you have to calculate, Medicare, calculate, and then anything that's additional, again, that's if they reach over those thresholds. Hopefully they didn't, but if they did, congratulations, you're rich. So, but again, those thresholds that we do have. Alright, did you pay total cash wages of $1,000 or more? If no, stop. Again, this is one of those, like, just go through the steps, look at what's going on. So first part of Schedule H, again, is just calculating Social Security, Medicare, federal income tax. Here we have the FUTA, and right now you don't have SUTA, but you do have to calculate FUTA itself. And then actually here's SUTA right here. SUTA is right here. So you gotta calculate all that fun stuff. So yes, unemployment does come. This is more payroll-ish. So when you do your payroll taxes, tax course, we'll get more into this stuff, how to understand everything that goes on right there. So again, basically know what a nanny tax is, what the Schedule H is, probably how to calculate just a tad bit. So book basically gives a lot more stuff here, gives you a good old list here. Babysitters, do consider a household, but I don't know how much of a babysitter you go, okay. And do you have to issue out a W-2? Possibly. That depends. Again, and then here's their household, so they're showing it. This one, just know the understanding facts and how to basically calculate SUTA and FUTA. Not SUTA, FUTA. FICA and itself, Social Security, Medicare. And in case you do have to calculate FUTA or SUTA, again, they're not going to be too tough on the way it is. It's just knowing the wages, knowing the exemption limits. So, again, they're going to follow the same lines as social employment. So, that 9% is only over 200K or 250. Okay. Last little part, special taxes for high income taxpayers. This is mostly, again, dealing with the Affordable Care Act, which is basically leaving after this year. Yay. So it imposes an additional 3.8% of medical tax on net investment income for individuals. Again, AGIs with those thresholds of 250 for married and filing jointly, 125 for separate, and 200,000 for single. Well, this again includes interest, dividends, royalties, rent income. There, to arrive at net, can subtract allocated sales tax also, and we're reported on 8,960. Again, they get the 9% additional Medicare tax, and it's calculated on the SE, paid with Form 1040. And again, not allowed as part of deduction of AGI. So this is really for the high income. Well, we have a few, yes. Hopefully you do if you're open your own tax business. They're always good to have. But again, a lot of that taxes is going away. Because again, that's on the Affordable Care Act. As you can see, they do bring in a little bit more stuff. Again, this is all the investment, passive, and items not subjected, tax exempt interest, excluded gains on sale of principal residence, distributions from retirement plans, IRAs, wages and self-employment income. So here's our form for them. Again, the best thing with taxes is going through that actual forms themselves and just read what they do. I mean, if you print these things out and actually look at them, it finds out very quickly exactly what's going on. And again, this gives a good example going on. So taxpayer ABC, modify AGI, because apparently they didn't really give us the AGI. 1,900, oh no, I don't know why I'm reading it that way. 190,000. Threshold is 200K. There is no excess over threshold. Investment income, we don't have really anything right there, because again, greater of the two, or lesser of the two, sorry. Lesser of excess are investment income, and A, taxpayer A owes nothing. Yay. Taxpayer B, 220,000 is modified AGII. Again, adjusted gross income. They basically are the same thing. Threshold, take out 20, so they're over 20,000. Investment income was 80K, take the lesser, 20,000 times that at 3.8, 760. Here again, this time we have 340. Their investment income is 80K. 80K happens to be lesser than the excess, so we take the 80 and times that by 3.8. And that's it on that. Here's the additional, where they're telling us to do it on the additional Medicare, 89.59 to 0.9. Again, this shows up on the 1040. And then the book goes in a little bit more with employees doing the same thing, and self-employment tax. One more time, it wants to do self-employment tax. So that's basically it for chapter 6. And again, just adding a lot more new special taxes and knowing what they are. Again, I kind of went a little bit more in depth, a little bit of the calculations, but print out the tax forms. It helps out so much with these special ones, and it lists everything and how to calculate it out. Okay, cool stuff there. You can even look up instructions. If I didn't know what this was, and I want to find instructions, you can actually search on irs.gov, and it's going to actually pop up instructions for certain forms. Here's instructions for Schedule H, Form 990, how they give two different ones, are they combined? And I would say sometimes just reading this stuff actually helps out if you really want to get that understanding of tax. If not, you just want to go simplistic, just go right through to the form, go down it, understand how it goes. Again, it's tax, a lot of words, forms, but we got software, and you start learning as you go. Again, taxes are more of practicing with your hands than reading sometimes, but either way, however you like to learn. But this does conclude chapter 6. So for the ado, this is your Professor Naragon signing off on this another great tax adventure.